to spot a fake angel investor. The following tips will help you notice if you're dealing with a fake. Number 1. There is no history of any previous investments. When you ask them about this, you get vague or defensive answers. Anyone can claim to be an angel investor, as there are little checks or regulations for this area. Most online platforms, angel investor groups, or smaller pitching events do not validate the credentials of those that join. It is very much a case of buyer be aware. You could be dealing with a totally random person with no investments offer and no experience in the industry. It is a totally legitimate question to ask of any potential investor. Which companies have you invested in before, and how have you helped them grow their business? Number 2. An offer of guaranteed investment if you pay them an introducer fee. No one can guarantee investment. There are simply far too many variables. Even if they do introduce you to another investor, they are unlikely to be able to influence their decision as to whether they like the team, product, and think they are investment worthy. It's a highly subjective process. Each investment takes a different amount of time because each investor has their own processes, so there cannot be a guaranteed time frame to funds being transferred. The process simply doesn't work like that. Number 3. They only prey on women and invite them out in the evening alone. Business conversations should happen during business hours. There are lots of stories about female founders attending uncomfortable one-to-one dinners and drinks where the conversation is steered away from business and onto personal matters. Attending this is a complete waste of time as they will never actually invest. Number 4. They approach founders first. Legitimate investors do not have a shortage of deal flow as they are inundated with direct pitches as well as trusted referrals from their advisors and partners. They do not need to approach founders first, unless they are hosting an event or accelerator. If you receive an unsolicited message via your social media channels to discuss investment in your startup, you should proceed with caution, particularly if you're a pre-revenue startup. It's a crowded space. Why would they target an early-stage startup with little traction? That's very high risk for them. Number 5. They chase you for a response. Real investors take their time before committing to an investment. As a general rule of thumb, they don't chase you. You're more likely to chase them for any response. If your investor is chasing you and the contact is one way, this can be a major red flag. Number 6. They are not heading towards issuing a term sheet anytime soon. When everything is informally agreed, if they do issue a term sheet, the funds are never transferred. Familiarise yourself with the process of investment. What promises is your investor making, and how long has it taken them to act upon their words? Investors receive a lot of new pitches, but very few are interesting to them. If they are genuinely interested by your pitch, they really get enamoured by it and move towards finalising the deal. If they are not moving towards that milestone, this usually means they have doubts. Are they confirming details in writing, over email, or is everything agreed orally? Number 7. There's no website or company name. They operate alone. Most legitimate investors feel passionately about the startup ecosystem and regularly post about it. If the only online presence they have is general commenting on other founder posts, you should dig a little deeper. If they do have a website, always double check their URL and their contact details. Number 8. They are full of excuses and too busy to take your call. They will string you along for months or even years without any firm commitment or indicative time frame. Number 9. They are unclear or deceptive about their intentions with your business. This leads them to be impatient and focused on a fast cash grab. You can tell when they are doing this by the level of guidance or mentoring they provide you as you build your business. It is best to clarify your intentions and expectations early on with any potential investor to avoid this scenario. Finally, number 10, they target your vulnerabilities. Be careful what you post on your social media as they tend to look for those who clearly have a very short cash runway or are desperate. This is music to their ears. If you do have a very short runway, you should think about how you can increase revenue without increasing your costs, instead of focusing your time on finding an investor to fund your urgent working capital requirements. Here are 4 bonus questions to ask. How are they involved in the startup ecosystem? Most angel investors invest because they want to mentor founders. They want to make a difference and give back. They're generally not in it purely for the financial returns, even though the money is coming directly from their pocket. How much knowledge do they have of key industry terms? Do they seem knowledgeable about equity, valuations, convertible notes, and raising additional funding rounds? Do they have useful contacts in your industry? This could be customers, other investors, lawyers. Do they have relationships with VCs who could fund your next round? Thank you for watching this video. Please leave a like, comment and share if you found it useful. And also subscribe to keep updated on any new videos we might post that could be useful to you.